Good day, everyone. Welcome to Basic Risk Management Training. Our learning outcome for this training are to understand risk management as a discipline, its history and applications in financial institutions, to learn and appreciate the value of risk management tools and processes, to learn and refresh the recent significant regulations of BSP or the Bangko Sentral ng Pilipinas and share practices of their implementation, to learn of the book's techniques in implementing an enterprise risk management program. The detailed application of different management tools will be covered in another course. My colleague Mary will alternatively explain some of the slides.
To achieve our learning outcome, the course are divided into the following modules. 1. Risk and risk management. 2. Contextualizing risk management. 3. Risk management processes and applications. 3a. Credit risk management. 3b. Operational risk management. 3c. Market risk management. 4. Recent significant regulations. 5. Digital economy, financial technology overview. 6. Case studies and solutions.
We have 4 cases. Case 1. Urbanization, risk assessment on launching of new product and a variant. Case 2. Rebooting microfinance. Case 3. The rise of middle class, new market entrants, technology forces, and millennials. And case 4. Pandemic COVID-19. At the end of the training, we will apply what we have learned to solve these cases.
Let us look in the past. Ferdinand Magellan requested for an investment of silver maravedis from Charles I, King of Spain. Goal: to discover a westerly route to Asia, thereby permitting circumnavigation of the globe. The risk is the uncharted course of travel. In actuality, before he reached his destination he faced the risk in the ocean, among his people via mutiny, and the destination itself in which he faced natives. The expected reward, percentage of expedition's revenue, 10-year monopoly of the discovered route. Our organizations are in the same process. As they say, a ship is not a ship if it does not sail. So a bank is not a bank if it does not lend. So taking risk is inherent in banking. Let us discuss risk and risk management.
Let's proceed to risk and risk management.
What is risk? The vastness of this topic is daunting. Risk touches on the most profound aspect of psychology, mathematics, statistics, and history. It even includes personal circumstances, just like what my former colleague usually uses as an example. When you fall in love, there is always a probability that such love will be unrequited, also that you maybe fall out of love. But let us focus on risk as we see it in our industry. I have 3 favorite definitions of risk. First, from the book Risk Management: Capital Adequacy. It says risk is a condition in which there exists a possibility of deviation from a desired outcome that is expected or hoped for. Note that it spoke of the condition, not specific whether personal or organizational. In the illustration, the risk of falling from the rope is based on the condition of the wind, the strength of rope and the ability to walk on it. The German sociologist Niklas Luhmann says, risk is the threat or probability that an action or event will adversely, or beneficially, affect an organization's ability to achieve its objectives. In the illustration, we can see the commercial center of Makati. Will it be able to continue to be a place of trade if terrorists would be allowed to operate freely? In the area of Rizal province? Will it be a good place to reside considering the risk of landslide? In our online transactions, are we sure we are secured? Our account balance will not be reduced without proper authority? Or purchases will be transacted without our knowledge? There is a risk of loss always. However, note that in the definition, he mentioned beneficially. Thus the other side of the coin with loss is the reward. Taking risk is either a loss or a reward. Dr. Chaoff, as author of the book Managing Risk in the New Economy, says, risk characterizes the uncertainty of certain planned or expected outcome. There are 3 things we can learn from this definition. First, not all risks are adverse. They can be also beneficial. Second, there is an expectation, but a deviation from it may happen. Third is the planned or expected outcome, thus it is possible that we can accept risk, or the risk of loss depending on our plan, or the desired outcome. We can accept risk if there is greater opportunity, we can accept a loss, if compensated by a greater reward. Risk is not something we continuously eliminate. Risk can be managed. Before we proceed to the characteristics of risks, let us have a snap question. What is the difference between the risk in casino gambling and the risk in buying stocks? A. None. B. The risk and reward in casino gambling is lower than in buying stocks. C. The risk and reward in casino gambling is pure luck, while in buying stock the company can be well studied in relation to the economic situation. Please check or jot down your answer. Let us look at the characteristics of risk. First, it is situational. In the previous slides on definitions, it states that risk is a condition in which there exists a possibility of deviation from a desired outcome that is expected or hoped for. There is a situations in which risk may or may not occur. In the illustration, the situation is that Mr. X wants to be in another building very fast, however. Instead of going down via elevator, and a short walk, he decided to use a rope. Now the situation is, Mr. X going to another building via rope, there is a risk that he may not be able to attain his objective of going faster, or probably not reaching at all because of high probability of falling. We can refer to situational also as probability. In real-life scenario, examples are, we want to launch a product fast even without complete approval. We want to have more accounts, then adjust credit scorecard. Earn big bucks quicker, thus buy unknown bond names from emerging markets. K can be diversified through separation of business units or use of redundant system. A key objective in operational risk management is to reduce the single point of failure. Correlation should be stress test. The third characteristic of risk is, it is change-driven. Our definitions of risk use the word deviation and action versus outcome. In this situation, all factors remain as expected that Mr. X will be able to reach his objective. If there is a change in wind direction or velocity and a bird will unexpectedly distract Mr. X, surely he will fall. In actuality, if no change on the plan or derive outcome, there is no risk. But, risk will surface if the factors we consider to be stable will change. While we anticipated pandemic, we have not able to predict the impact of COVID-19. With COVID-19 we thought Philippine peso against US dollar would be worse, which is the opposite of what is happening today. Of course the factors of US being affected more by the pandemic and recent civil unrest was not in the equation. We can also refer to change driven as volatility. Volatility is a measure of uncertainty, the variability in potential outcome. More specifically, volatility is the magnitude of upside or downside of the risk taken. Volatility is an important driver of the overall potential loss or gain. The greater the volatility, the greater the risk. In actual life scenarios, the number of loans that turn bad is proportionately higher on average in credit card loans than in commercial loans. This is due to credit card being an individual unsecured loan and source of income is varying. On the other hand, among secured loans, real estate lending is widely considered to be riskier because historically the price and market is changing. The fourth characteristic of risk is, it is time-based. We often hear that in love, there is no forever, it is the same in risk. Conditions and objectives are time-bound, thus the risk follows. Time-based can be also described as time horizon. Time horizon is the duration of risk exposure or how long it would take to reverse the effect of decision or event. The longer the duration, the greater the risk. Extending a 1-year loan is less risky than extending 10 years for the same borrower. Highly liquid instruments such as treasury bonds are generally less risky than lightly traded securities such as unlisted equity, structured derivatives, or real estate. This is because investor can take their positions quickly should the need arise. In operational risk, the horizon depends on level of preparation. A fire that burn a computer center to ground will leave the company exposed until the backup facility become online. The risk is greater for organizations that do not have a well-established and tested preparedness procedure to recover. The fifth and last characteristics of risk is magnitude dependent. Even if a change occur, but if not that much, or it is tolerable, or expected, it can be considered as there is no risk. Risk magnitude dependent or always has an impact, depending on the severity. But, this would also depend on the exposure. Risk exposure is the maximum amount of economic damage resulting from an event. The damage can take in a form of financial or reputational loss. All other things being equal, the risk associated with that event will increase as the exposure increases. For example, a lender is exposed to the risk that the borrower will default. The more he lends, the more he is exposed to the risk of default. While exposure is defined as the amount of the worst that could possibly happen, severity, by contrast, is the amount of damage that is likely to be suffered. The greater the severity, the greater the risk. Severity is the partner to probability. Severity more often is a function of other factors like volatility in market risk, collateral in credit, and applicable risk cushion in operational risk. Risk is a bell curve. The term bell curve is used to describe the mathematical concept called normal distribution, sometimes referred to as Gaussian distribution. Bell curve refers to the bell shape that is created when a line is plotted using the data points for an item that meets the criteria of normal distribution. In a bell curve, the center contains the greatest number of a value and, therefore, it is the highest point on the arc of the line. This point is referred to the mean, but in simple terms, it is the highest number of occurrences of an element, in statistical terms, the mode. The important thing to note about a normal distribution is that the curve is concentrated in the center and decreases on either side. This is significant in that the data has less of a tendency to produce unusually extreme values, called outliers, as compared to other distributions. Also, the bell curve signifies that the data is symmetrical. This means that you can create reasonable expectations as to the possibility that an outcome will lie within a range to the left or right of the center, once you have measured the amount of deviation contained in the data. This is measured in terms of standard deviations. To understand the probability factors of a normal distribution, you need to understand the following rules. The total area under the curve is equal to 1 or 100%. About 68% of the area under the curve falls within one standard deviation. About 95% of the area under the curve falls within two standard deviations. About 99.7% of the area under the curve falls within three standard deviations. Risk events are typically those are outside the 68% standard deviation. Examples are the 9/11 terrorist event in US, the global pandemic COVID-19, and the anti-money laundering case in RCBC. The impact would depend on the process and business. In describing the characteristics of risks, we use Mr. X walking in the rope. Now let us have 5 examples based on the actual events. The first case is the BPI system glitch. Many BPI clients received a shock on Wednesday morning as they woke up to the news that their accounts saw a couple of unauthorized transactions. These transactions even brought many account balances to zero, and negative for some. BPI account holders claimed on social media that they have lost a huge sum of money, and some even found their account being debited or credited twice for a transaction in the past. In a statement on BPI's official Facebook page, they said, due to an internal data processing error, some clients may have seen their accounts debited twice or credited twice for a past transaction. However, BPI said that they are currently correcting the transaction history and reassured their customers that the glitch was not caused by hacking. In a separate statement, the bank said that they have already identified the internal system error that is causing the transactions which occurred between April 27 and May 2 to double post on June 6. This risk event even led to a Senate hearing and a glitch in the BPI's stock price. Our second case is the RCBC money laundering violation. This risk event is part and parcel of the Bangladesh bank robbery, also known colloquially as the Bangladesh Bank cyber heist in February 2016. 35 fraudulent instructions were issued by security hackers via the SWIFT network to illegally transfer close to US $1 billion from the Federal Reserve Bank of New York account belonging to Bangladesh Bank, the Central Bank of Bangladesh. 5 of the 35 fraudulent instructions were successful in transferring $101 million, with $20 million traced to Sri Lanka and $81 million to the Philippines. The Federal Reserve Bank of New York blocked the remaining 30 transactions, amounting to $850 million, due to suspicions raised by a misspelled instruction. All the money transferred to Sri Lanka has since been recovered. However, as of 2018 only around $18 million of the $81 million transferred to the Philippines has been recovered. Most of the money transferred to the Philippines went to 4 personal accounts, held by single individuals, and not to companies or corporations. It was later suspected that Dridex malware was used for the attack. The suspicious activities of the staff at the Rizal Commercial Banking Corp., RCBC, in the Philippines cannot be ignored either, since they acted with lightning speed to launder the money out of the bank and into the gambling industry, in complete violation of the Philippines Anti-Money Laundering Laws and in total disregard of the instructions of the Central Bank of the Philippines, which had ordered a freeze on the recipient accounts. The money trail involved RCBC, PhilREM Service Corporation, Solaire Resort and Casino, Midas Hotel and Resort, and some casino junket operators. Many personalities are involved, especially the sacked RCBC Jupiter branch manager Maya Santos Digito. The case is interdependent on the procedures and instructions which was not followed. It is time-bound as it happened in Feb-March 2016 from hacking of Bank of Bangladesh account to return of some of the money. The RCBC impact is 1 billion pesos penalty plus fall of stock price. The third case is WorldCom. WorldCom was not just the biggest accounting scandal in the history of the United States, it was also one of the biggest bankruptcies of all time. The revelation that telecommunications giant WorldCom had cooked its books came on the heels of the Enron and Tyco frauds, which had rocked the financial markets. However, the scale of the WorldCom fraud put even them in the shade. Key takeaways: WorldCom was a telecommunications company that went bankrupt in 2002 following a massive accounting fraud. WorldCom remains the biggest accounting scandal in U.S. history as well as one of the largest bankruptcies. As a result of the scandal, former CEO Bernard Ebbers was sentenced to 25 years in prison, and former CFO Scott Sullivan was sentenced to 5 years. Understanding WorldCom and Bernie Ebbers, WorldCom has become a byword for accounting fraud and a warning to investors that when things seem too good to be true, they just might be. Its CEO, Bernie Ebbers, a larger-than-life figure whose trademark was cowboy boots and 10-gallon hat, had built the company into one of America's leading long-distance phone companies by acquiring other telecom companies. At the peak of the dot-com bubble, its market capitalization had grown to $175 billion. When the tech boom turned to bust, and companies slashed spending on telecom services and equipment, WorldCom resorted to accounting tricks to maintain the appearance of ever-growing profitability. By then, many investors had become suspicious of Ebbers' story, especially after the Enron scandal broke in the summer of 2001. Shortly after Ebbers was forced to step down as CEO in April 2002, it was revealed that he had, in 2000, borrowed $400 million from Bank of America to cover margin calls, using his WorldCom shares as collateral. As a result, Ebbers lost his fortune. In 2005 he was convicted of securities fraud and sentenced to 25 years in prison. Cooking the books: this was not a sophisticated fraud. To hide its falling profitability, WorldCom inflated net income and cash flow by recording expenses as investments. By capitalizing expenses, it exaggerated profits by around $3 billion in 2001 and $797 million in Q1 2002, reporting a profit of $1.4 billion instead of a net loss. WorldCom filed for bankruptcy on July 21, 2002, only a month after its auditor, Arthur Andersen, was convicted of obstruction of justice for shredding documents related to its audit of Enron. Arthur Andersen, which had audited WorldCom's 2001 financial statements and reviewed WorldCom's books for Q1 2002, was found later to have ignored memos from WorldCom executives informing them that the company was inflating profits by improperly accounting for expenses. This spate of corporate crime led to the Sarbanes-Oxley Act in July 2002, which strengthened disclosure requirements and the penalties for fraudulent accounting. In the aftermath, WorldCom left a stain on the reputation of accounting firms, investment banks, and credit rating agencies that had never quite been removed. To hide its falling profitability, WorldCom inflated its net income and cash flow by recording expenses as investments, reporting a profit of $1.40 billion instead of a net loss in Q1 2002. The fallout. Bernard Ebbers was convicted on 9 counts of securities fraud and sentenced to 25 years in prison in 2005. Former CFO Scott Sullivan received a 5-year jail sentence after pleading guilty and testifying against Ebbers. On December 18, 2019, Ebbers was granted early release from prison for health reasons after serving 14 years of his sentence. Thanks to debtor-in-possession financing from Citigroup, JP Morgan, and GE Capital, the company would survive as a going concern when it emerged from bankruptcy in 2003 as MCI, a telecom company WorldCom had acquired in 1997. However, tens of thousands of workers lost their jobs. Without admitting liability, WorldCom's former banks, including Citigroup, Bank of America, and JP Morgan, would settle lawsuits with creditors for $6 billion. Of that amount, around $5 billion went to the firm's bondholders, with the balance going to former shareholders. In a settlement with the Securities and Exchange Commission, the newly formed MCI agreed to pay shareholders and bondholders $500 million in cash and $250 million in MCI shares. Of course, in the next picture, who would forget the 9/11 terrorist attack? Coronavirus disease, COVID-19, is an infectious disease caused by a newly discovered coronavirus. A global pandemic is declared by World Health Organization. As of this writing, globally there are more than 9.1 million confirmed cases and 475,000 deaths. In Philippines, there are 31,000 confirmed cases and 1,070 deaths. While in business continuity regulations and banks execution pandemic is included, its effect is only anticipated to the extent similar to SARS. The impact of COVID-19 was not anticipated. This pandemic resulted to negative growth amongst country economies, heavily affected various industries such as airlines, hotel and restaurants, among others. Work from home and social distancing becomes the new normal. What are the lessons learned from the actual events? 1. Much stricter compliance requirement. This becomes one of the primary drivers of risk management. After WorldCom and Enron, Sarbanes-Oxley was enacted. 2. Increased board-level oversight. The establishment of risk committees becomes mandatory. 3. Greater risk management independence. This is shown by the risk unit become an independent and directly reporting to the board. 4. Focus on enterprise risk management. It means risk should not be managed per silos. 5. Improved board and management reporting. The dashboard reporting must become holistic. 6. The creation of objective feedback loops. We have now seen the escalation processes and whistleblowing. 7. Better incentive compensation systems. The risk-adjusted financial performance now drives compensation system. Lastly, 8. Modify the business model as necessary to include managing of strategic risks. Before we proceed to risk management, Please match the risk to the risk type. Please remember and check the correct answer at the end of the module.
If you have questions, please email us at jd@obsolescexcellence.com or jjuneda@gmail.com. Thank you.